Assalamualaikum and hi everyone. Today, our group will be presenting a financial reporting and ethical analysis of the NTK Corporation Berhad case study. Throughout this presentation, we will analyze the key financial reporting issues based on the relevant Malaysian financial reporting standards, discuss the ethical application using the ADAP framework, and provide recommendations to improve financial reporting and ethical decision making. So let's begin with the company background first. So, NTK Corporation Berhad is a publicly listed technology manufacturer. The company recently obtained a major loan from Zenith Bank to finance a new investment project. However, the loan agreement requires NTK to maintain a debt-to-equity ratio below 50%. In addition, NTK wanted to report a strong earnings per share, or EPS, to attract potential investors. These financial pressures influenced several accounting decisions made by the company's management and led to the financial reporting issues discussed in this case. The first financial reporting issue is revenue recognition under MFRS 15. In December 2025, NTK delivered goods to Omega Trading Berhad. Although the goods were physically delivered, Omega would only pay after selling the goods to its end customers. Despite this arrangement, Ahmad instructed Alia to recognize the full revenue immediately. To evaluate whether this treatment complies with MFRS 15, we apply the 5-step model. Step 1 and Step 2 are satisfied because there is a valid contract and the performance obligation is to deliver the goods. Step 3 is not satisfied because the payment depends on Omega successfully selling the goods, which means the consideration is still uncertain. Step 4 is satisfied because there is only one performance obligation. Finally, Step 5 is not satisfied because the performance obligation has not been fully satisfied in the substance. The arrangement appears similar to a consignment arrangement where revenue should only be recognized when the goods are sold to the end customers. Therefore, NTK recognized the revenue too early. This would overstate the revenue, profit and earnings per share, which could mislead investors and lenders. Based on MFRS 15, revenue should only be recognized when all the recognition criteria have been met.
I'll begin with issue 2, which is earning management. In this case, Ahmad instructed Alia to delay recognizing operating expenses that had already been incurred in 2025. Although he claimed these expenses were not relevant to the current reporting period, his actual objective was to increase the company's reporting profit so that it could satisfy the loan covenant and support future expansion plan. This is considered earnings management because management intentionally manipulates accounting figures to achieve a desired financial outcome instead of presenting the company's actual performance. This action does not comply with MFRS 101, which required financial statement to present a true and fair view. It also violates the conceptual framework, particularly the principle of factful representation, because the financial information is no longer neutral or free from bias. Alright, next, I'll explain the appropriate accounting treatment and its impact on the financial statement. Because these expenses were occurred in 2025, MFRS 101 required them to be recognized in the same reporting period. Therefore, operating expenses should be recognized in the same reporting period in which they are incurred. Management cannot delay recognizing expenses simply to report higher profit or meet loan covenant requirement. By postponing these expenses, the company understates its operating expenses while overstating its profit, retained earning and financial performance. As a result, important financial ratios such as the profit margin and return on asset also appear stronger than they actually are. Moving on to issue 3, which is deferred expenses. In this case, Ahmad instructed Alia to postpone the recognition of operating expenses that had already been incurred during the financial year end 31 December 2025. Although he claimed these expenses were not relevant to the current reporting period, his actual intention was to increase the company's reported profit and meet its loan covenant requirement. However, under financial reports principles, expenses cannot be deferred simply to improve financial performance. And expenses can only be deferred if it qualifies as an asset by providing probable future economic benefits, and the case provided no evidence that these operating expenses meet that requirement. Therefore, this accounting treatment does not comply with MFRS 101, which required financial statements to present a true and fair view and recognize expenses in the appropriate reporting period. It also contradicts the conceptual framework, which requires financial information to faithfully represent the economic substance of transactions and remain neutral and free from bias. As a result, postponing these expenses is inappropriate and leads to mislead financial statement. I'll discuss the appropriate accounting treatment for deferred expenses. In this case, the operating expenses were incurred during the financial year 31 December 2025. Therefore, under the accrual basis of accounting, these expenses should be recognized immediately in the SOPL for the current reporting period. Management cannot postpone recognizing these expenses simply to improve the company's financial performance or to meet its loan covenant requirements. As a professional accountant, we are expected to exercise objective judgment and ensure that our accounting decisions comply with the relevant MFRS rather than management's personal objective. Therefore, Alia should have recognized the expenses in 2025 despite the pressure from Ahmad. If these expenses are improperly deferred, operating expenses will be understated while profit before tax, net profit, and retained earning will all be overstated. If the expenses are incorrectly capitalized as assets, total assets will also be overstated. As a result, the reliability of the financial statement is reduced and stakeholders may make decisions based on inaccurate financial information. So, in conclusion, deferred expenses should only be recognized when they meet the recognition criteria of an asset. Otherwise, they must be recognized in the current reporting period to ensure the financial statement present a true and fair view.
Moving on to our next section, which are ethical issues regarding premature revenue recognition. Ahmad instructed Alia to immediately recognize the full revenue of goods delivered to Omega Trading Berhad in December 2025. This violates MFRS 15 as the transaction should not be recorded until the performance are completely met. Ahmad's pressure comes from lagging year-end sales target that he is desperately need to hit. This creates a severe impact on stakeholders as they are misled into thinking the company has high demand and strong cash flow. Consequently, Alia faced an intimidation threat since Ahmad holds total power over her career, forcing her to comply with his demand. Applying the auto tree process to this revenue issue. First, Alia observed Ahmad instructing her to record unearned revenue early. She thinks that and realized that because payment is not being made, it creates a false performance. Then she understands this is deliberate breach of MFRS 15 driven entirely by Ahmad's pressure to hit year-end figures. So Alia remembered that revenue can only be recognized when the performance obligation is fully met. So upon reflection, she knows that making false entries will mislead the market and breaks the professional boundaries. So she feels deep remorse and guilt for compromising company's growth out of her view.
I will now apply the 5 dimensions of NIAM on our first ethical issues, which is the premature revenue recognition. By breaking down to the first dimensions, which is NIAT, Ahmad's intention is corrupted by self-interest and greed because he wants to manipulate revenue figures and boost management compensation. Meanwhile, for Alia, her intention shifts to self-preservation because she is driven by the immediate fear of losing her job while on probation. For Iftiar, Ahmad actively directs a shortcut to fake the performance obligation completion. Meanwhile, Alia submits to the pressure rather than looking for safe channels to challenge the entry or flag the consignment nature of the transaction. This transaction totally violates the amanah because investors and shareholders are intentionally being given a false impression that NPK has strong consumer demand and immediate cash flow generation, when in reality, the goods are just sitting on the distributor's shelf. In Muraqabah, Ahmad asks if there is no internal oversight or eventual audit consequences for fabrications. Alia feels the internal moral conflicts of this lack of monitoring but lets her fear of management overrule her conscience. The toxic outcome is an artificially inflated top-line revenue figure that exposes NTK's serious regulatory penalties, financial statements, and a complete wipeout of market credibility when the revenue has to be reversed.
Next, we look at issue number 2, which involves misleading earning per share EPS disclosure under MFRS 133. Ahmad chose to intentionally hide the future dilutive effect to the company's convertible debt to make NTK's financial health appear much safer and stronger. His management pressure comes from an urge to maintain a high EPS to attract more investors for their upcoming expansion plan. This gives impact to potential shareholders to overestimate the company's real earning performance because they do not know and they do not realize how future dilution will lower their share value. And this gives Alia a severe advocacy trait since she is forced to compromise her professional objectivity to promote a falsely inflated financial position to the public. Looking at the auto-tree framework for the EPS issue, Alia observed Ahmad dictating minimal disclosure by hiding the convertible debt details. She thinks that omitting this information compromises long-term investor confidence, and she understands this is a deliberate under of MFRS 133 to protect their market image. Alia remembered that financial report must be completely transparent and unbiased. Then she reflected that misleading the information may put the company's reputation and her own job safety at risk. In the end, she feels strong remorse and guilt for preparing a false presentation just to safeguard her probation.
Now, for the second ethical issues, which is misleading EPS disclosure, for NIAT, Ahmad deliberately chooses to hide the future dilutive effect of convertible debt under MFRS 133 so NPK's earnings appear artificially stronger and safer. Meanwhile, Alia is caught in an advocacy threat. Her intention is compromised as she is manipulated into helping promote an over-optimistic, unbalanced financial distortion to the open market. For Ikhtiar, this leads into Ahmad putting his efforts to minimizing financial disclosures by intentionally omitting diluted EPS. It is required to diligently display both basic and diluted EPS to fully apprise the market of potential share dilution. The company has violated its fiduciary amanah to potential shareholders, actively leading them to overestimate long-term earnings performance and risk profiles. For Muraqabah, Ahmad lacks moral self-consciousness because he assumes that external investors will not examine the debt footnotes closely enough to discover the missing dilution metric. This results in an unsustainable inflated stock assessments. Once those debt instruments inevitably convert into equity, this will lead to a massive drop in stock price and potential shareholder lawsuits for non-disclosure.
Our last case is issue number 3, which is hiding Alpha Tax bankruptcy under MFRS 110. When a client goes bankrupt before the audit is finalized, it must be recorded as bad debt loss immediately. So hiding it is considered as a fraud. Ahmad is panicking because of a strict bank loan rule, which the company's debt ratio must be below 50%. If they record this loss, they break the rule and the bank could shut the business immediately. The impact is that shareholders are completely blinded to the true loss. So Alia faces a self-interest threat, meaning she is torn between doing her honest job or hiding fraud to keep her paycheck. For the final Auto 3 cycle, Alia observed Ahmad's sudden request to hide the bankruptcy right before the audit. She thinks that this event provides clear evidence of a loss that existed at the reporting date. She understands that omitting this will violate MFRS 110, forced by Ahmad's pressure over the Zenith Bank loan rules. Alia remembered that the MIA by law strictly forbidden an accounting from being associated with false report. Then she reflects that hiding this massive loss leaves Zenith Bank exposed to extreme financial risk. Finally, she feels deep remorse and guilt for being pressured into fraud due to her vulnerable position as a probation employee.
And the last ethical issues, which is omission of Avatar bankruptcy. In the end, Ahmad intent is outright financial statement fraud. He knowingly hides a material adjusting subsequent event under MFRS 110 to cover up a massive bad debt. Meanwhile, Alia, driven by an acute self-interest drive, her intention centers entirely around career survival on probation, leading her to willingly become an accomplice in concealing material losses. Ahmad puts active effort into suppressing information and covering up of Attack's public bankruptcy. He chooses a deceptive cover-up instead of making an honest effort to negotiate proactive debt restructuring options with Zenith Bank. In Amanah, the director completely betrays the company's trust with Zenith Bank and current shareholders by actively hiding the severely degraded value of NTK assets. In Muraqabah, Ahmad demonstrates a complete blindness to risk monitoring by ignoring the reality that independent auditors will easily uncover Alpha-Tax Bank public bankruptcy filing. The final outcome is catastrophic liquidation risk because Zenith Bank can demand immediate repayment of the entire loan once the covenant breach is discovered, threatening the company's going concern status.
For the first ethical issue, NTK should recognize revenue only when control of the good has been transferred to the customer. As required by MFRS 15, recognizing revenue too early is like counting a goal before the ball enters the net. It make profit look higher than it really is. To prevent this, major revenue transactions should be reviewed by the finance manager or audit committee together with the supporting documents and contract terms. NTK also should provide regular ethics and MFRS 15 training for accountants to maintain professional judgment and do not record revenue early under management pressure. For the second ethical issue, NTK should comply with MFRS 133 by disclosing both basic EPS and diluted EPS, especially because the company has convertible debt. This gives investors complete and transparent information. The audit committee should review and approve all the EPS calculation before the financial statement are released. Regular ethics and MFRS 133 training should be also provided so staff remain honest, objective, and compliant with professional standards. Overall, this recommendation improve transparency and strengthen controls and increase investors' confidence. For the third ethical issue, NTK should follow MFRS 110 by assessing Alpha-Tax bankruptcy as a subsequent event. If the receivable was already impaired before the reporting date, the company should recognize the impairment loss. By significant event after the reporting date should be reviewed by audit committee before the financial statement are finalized. NTK also should provide ethics and MFRS 110 training and encourage employees to report unethical instruction through proper channels. Overall, this recommendation improves transparency, strengthen ethical behavior, and makes the financial statements more reliable.
Now, I'd like to reflect on how this recommendation can improve NTK's financial reporting. First, this recommendation helps prevent similar ethical issues from happening again. Stronger internal control, proper supporting documents, and review by the audit committee make it much harder for management to manipulate financial information. Regular ethics training also reminds employees to do the right things, even when they are under pressure. Second, this recommendation helps NTK continue to comply with accounting standards by following MFRS 15, MFRS 110, and MFRS 133 correctly. The company can ensure that revenue subsequent events and EPS are reported accurately and consistently. Third, they promote ethical financial reports by encouraging accountants to act with integrity and professional judgment. Financial information should always be based on accounting standards and evidence, not personal interest or management pressure. This makes the financial statements more honest and reliable. Finally, these recommendations help build a sustainable and responsible reporting culture. They encourage accountability and transparency, increase the confidence of investors and other stakeholders, protect the company reputation, and support long-term business success. Overall, these recommendations not only solve the current ethical issue, but also help entity maintain trustworthy and high-quality financial reporting in the future. That's all from us. Thank you.